Oftentimes we talk about the tax-free status of life insurance, but sometimes in some scenarios that's not always the case. It can become taxable, and most people, like Anthony, are not aware of those scenarios. So today what we're going to do is we're going to cover a few scenarios in which a policy could become taxable, and then we're also going to give you some solutions just in case you find yourself in that situation. Stick around.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be talking about is the tax features of life insurance.
Sounds exciting.
Very exciting. And today we're going to take some of our own advice because we often say that words are important. And I know I'm guilty of this. I know you're guilty of this. We often refer to as policy growth as tax-free, but technically it is tax deferred. So if we're looking for a quick workable definition, tax-free just means we don't pay any tax on it.
Yeah.
Right. Tax deferred means that we do pay a tax, but we're going to pay it at a later date. Right. So that's going to be what the difference is between those two. If we don't follow a certain set of criteria, the cash value could become taxable in whatever year we're going to start taking it out. If that's the case, right, then we do pay taxes on the gains. And if you're less or younger than 59 and a half, there also will be a 10% penalty. Yeah,
and just to be clear, this is why it's important that you're working with a good agent who understands these things and is going to help and guide you through the way. As long as you're following, we're assuming you have a good agent, but as long as you're following what they say and you keep this policy in force, it's going to be tax-free.
Yeah.
Right? But there's some things may happen, and maybe there could be some issues with the policy, and they could be taxable. So we're just talking about those rare instances where it could be taxable.
Absolutely. Let's get started.
Let's do it.
Yeah. I'm going to touch on the MEC limitations of a policy. The MEC meaning modified endowment contract. We've done podcasts on this. We've talked about this before. But really, modified endowment contract, what that means is that you put too much cash inside of an insurance policy and you lose the tax benefits on there. Now, that can happen for a couple different reasons. A poor design. Sometimes it's intentional. Most of the time, it probably not. I've had a couple scenarios in the past that I was going to share with you guys that, in fact, policies did become a MEC. One of them was, I don't know how this happened, but a gentleman actually paid an additional payment into his PUA rider. The insurance company took it, and he wasn't notified. And so it actually showed up a little bit later. We were notified that he put in too much money, and it showed up as a MEC. And so we did have the opportunity to go back in there and to take that out and apply it to the following year. So we have no idea how it happened, if he sent it in, if it got drafted. Somehow it did occur, but there was a resolution, and we were able to fix that one.
Well, and Cameron, how was the insurance company in working with you to fix this?
Man, I'll tell you what, right? Oftentimes we talk about what insurance companies that we want to work with, bigger the better is right, often said. But, man, you know what? There's some advantages to being able to talk and get an executive on the phone and say, hey, here's a situation that we found ourselves in, no fault of our own, right? How can we fix this? That was this scenario. Really, there was a phone call that was made. We were able to get in touch with the right individual. And I would say there was certainly an exception that was made here to remedy or rectify this situation for the client.
Well, and again, that's why it's important to be working with a good agent who's going to help you, and ideally a company, right? And we're only working with mutual companies, so we are the owners.
Yeah.
They're not trying to screw us or take advantage of us. No. The last thing they don't want your policy to become a MEC, because the last thing they want is it to become a MEC, say, in year 5, and you don't realize it till year 10, and you try to take money out, and it's taxable, then you're upset, and you may cancel the policy. So just remember, the insurance company, it's not like your auto insurance company, right? Because I've had my battles.
They're out to get you.
I've had my battles with them. But we're on the same team.
Yeah, absolutely. And if you think about the number of times that somebody has made a premium on a policy, just for my clients, your clients, and for this to happen, one time in the 13 years is absolutely the exception. But man, what an advantage to be able to call somebody up and say, hey, we need some help here. So great scenario. The other one that I would share with you guys, again, is just kind of a one-off scenario where we had a 1035 scenario. 1035 is where you take money from an existing insurance policy and just move it right over into another one. No taxable event, right? You just carry it right over. And somehow, some way, we were off by like $6,000 in cash value that was brought over. Typically, if you're off by more than 10%, what will happen is the insurance company will reach out to the advisor, say, hey, here's how much we had. Please run us a new illustration. Mm-hmm. Again, one-off scenario. That didn't happen. Somebody wasn't notified for whatever reason. And again, several months later, we found ourselves in a MEC status on that policy. And again, we're able to call them up, talk to them, say, hey, what happened here? We really don't know exactly how that happened, but you know what? We're able to rectify it and remedy it. So,
well, Cameron, I appreciate your transparency.
Yeah.
Right. And that it does happen. And it's happened to me once.
Yeah.
Right. So you more than me on this, but it does happen. Right. Yeah. But there's solutions in there. Mm-hmm. How much time, if a policy does become a MEC, how much time do we have to fix it?
Good question.
Mm-hmm.
Well, if you listen to the insurance company, they're going to tell you 30 days. There's going to be some urgency in the wording of the letter that's given to you, but we have it on good word, and we spoke to a specialist several months ago, but we actually have, by the IRS, we actually have 13 months to be able to go in there and fix a MEC status on a policy.
And so we actually interviewed somebody from one of the top insurance companies and kind of gave the explanation. So you might want to check out that podcast.
Yeah, great video. Absolutely. All right, so number one is going to be a MEC. Typically, we can avoid any of the taxable events that may happen really at issue by policy design in relation to the MEC. So, Anthony, option number two in which a policy could become taxable.
Well, if we cancel the policy.
What does that mean?
Well, what it means is you're like, hey, I don't want to do this anymore. And you call the insurance company. They will send you a check for your cash value.
Yeah.
But what's happening is we no longer have a life insurance policy, so we no longer have that protection of taxes. Mm-hmm. Now, I mean, we're not going to get into it, but why would somebody cancel their policy, right? I mean,
life circumstances, it happens. Yeah.
And to me, where I've seen it happen most is people they don't understand.
Yeah. Oh.
Right.
Yeah.
Right.
I was gonna say I can't tell you the number of times that I've heard over the years where I've met with somebody that was late 40s, early 50s, and we talked to them about the advantages of whole life insurance, and they go, man, you know what? My parents had a policy for me, and I canceled it when I was 20 years old and took the cash out. Can't tell you the number of times I've heard that, and people are kicking themselves for doing it. They just didn't understand what they had.
Now, again, we have some options. If maybe IBC's for you, or you don't want to do this anymore, and that's okay. One option can be is what's called a reduce paid up.
What does that mean?
In essence, means is you tell the insurance company, hey, I'm not going to pay premiums anymore, and what they're going to do is they're going to recalculate the death benefit. Right, because the death benefit was assuming you were going to continue to make the premiums. They recalculate that. Cash value is going to stay the same. In fact, it's still going to grow. Mm-hmm. So we have that option. The issue is if you do that option before year 7, it's automatically going to MEC.
Yeah.
Right, and so worst case, if you don't want to do this anymore, do a reduced paid up, and at least you have that money. You could borrow it all out. But as long as you're at least paying the interest and keeping that policy alive, you won't have to pay taxes on that, right? And it's interesting. I think this RPU is kind of what we call it, our jargon.
Yeah.
It's a great option to have, right? Because just like you mentioned, life happens, and maybe we love IBC, want to do it, but our income went down, or something happened. It's nice to know that we have that option of the RPU. You know what doesn't have the option of an RPU?
I do.
I know you do know. It's IULs.
Yeah.
Right. And I know we've done a lot of content on that, but when it comes to a situation like this is a clear difference between whole life and IULs.
Absolutely. Good point. One of the many reasons why we like whole life insurance.
Now, the next reason would be is if your policy lapses. Now, a lapse is going to happen for one of two reasons. One is we stop paying premiums, or the premiums are due, but you're just not paying it.
Mm-hmm.
Okay, or if the loan becomes higher than the cash value, it's going to lapse. Okay, now we have some options. If you stop paying premiums, what's typically going to happen is called automatic premium loan, or APL. And what they're do is if your premium's $10,000, as long as you have enough cash value, they'll take that cash value. They'll take a loan to pay the premium.
Yeah.
Okay. Which is a great option, because sometimes things happen and you can't pay the premium, and with that loan, premiums paid, and you have many years, as long as you want, to repay that loan. So once you repay that loan, your money is going to be the same as if you had paid that premium anyways.
Yeah.
Right. So it is a good option. And now let's say you don't have enough cash value to pay the premium. Well, what's going to happen? The policy is going to lapse. We don't have the policy anymore. Now, well, technically what will happen is that what they do is they take that cash value and they buy some term insurance.
Extended term, yeah.
Right, extended term, and they do that as long until they extinguish all the cash value. But if you're in extended term, or even if the policy did officially lapse, there is an option for reinstatement. Because again, I can't reiterate enough, insurance companies on our team, right? So they don't want you to cancel that policy. Now, however, if you do cancel it or it lapse, once you cancel that or it lapse, their risk is no longer on the table.
Yeah.
Right? It's off the table. But they will reinstate it. But they're going to look at you may go through underwriting again. And this happened to me in one of the policies that I had at the beginning, where it didn't have a lot of cash value. And I tell you, to be honest, I just plumb forgot to pay the premium. Okay, I'm not gonna lie.
I thought you accountants had everything planned out on a fancy spreadsheet.
For other people, yeah, but not for ourselves. So we had to do underwriting. They asked for some medical records. I don't think I needed to be examined, but to be honest, I have a client who's going through this thing right now.
Yeah,
they moved. I don't know exactly what happened. They sent multiple notices. He didn't get it or whatever. But now 8 months went by. So the insurance company will reinstate it, but he's having to go through underwriting.
Yep.
And as long as there weren't any major medical issues, they will reinstate it. But the thing is, you got to look at the insurance company's point of view. What they're worried about is if somebody says, hey, I don't want this policy anymore, then 6 months go by and they have cancer.
Yeah.
And they're like, oh, you know what? I really wish I would have kept it. Now that risk for the insurance company is much higher. So that's why they are going to do that. Now, the second way policy can lapse, and that's if the loan gets higher than the cash value. What will happen then, and this typically happens when we're using this as cash flow in retirement, right? We're not paying premiums. Maybe we did the reduced paid up option, but instead of putting money in the policy, we start taking it out. And it's possible that that loan will get higher than the cash value.
Yeah.
So the downside of that's probably going to happen when you're older.
Yep.
Right. When you probably need the death benefit, right? But also that means you might have a huge tax bill, right? So one way around it, there's not a lot of companies that do it, but a couple that we write with do, and it's called, they have their own name for it, but like an overloan protection rider. In essence, what that does, if you meet certain criteria, like the policy has to be enforced for so many years, I think you need to be over 70. Mm-hmm. And what they will do is they will not let that loan go higher than the cash value. So they will lower the they will lower the interest rate on there if need be. And a lot of times we talk about, and even clients are looking for, this cash value. We got to look a little long term. I mean, that's why it's important to begin. I keep on saying this, but working with a good agent, but having a rider like this, if you're in your 30s or 40s, you're not even paying any mind.
Yeah.
But we've kind of been around here for a while where we have seen that it happens. And so we want to make sure that we protect you and that you know the options for you.
Great point. That overloan protection rider, I see it as like a backstop to you and I, right? If we fast forward 30, 40 years and people are taking income out of this and, God forbid we're not here for whatever reason to help them through that and manage that income that's coming off of it, man, they're going to have that APL rider. I always think to myself, there's going to be one client, right, that this probably affects, and it's going to be there to save that one client. I don't know who it is out of the whole book of business, right, but it's going to save that one, and that day I'm going to be like, oh, thank God. So great point. We talked about a couple features, that APL option. If you guys have a policy, pull it out and go look up there or log into your portal, check it out, and see if you have that automatic premium loan feature or extended term feature. I'm a bigger fan of the APL option.
For sure.
Yeah, so check that out. Make sure it is. If you guys have a policy, have questions on what your option is, reach out to us. We're happy to take a look. And then the other one is see if your policy has that overloan protection rider on there, because God forbid your advisor isn't there later on down the road and you get hit with a huge tax liability. We want to avoid that at all costs.
Well said.
Yeah, absolutely. All right, let's wrap this up, right? 3 taxable events. One was the MEC, right? We told you what that was, some possible solutions. It's really going to be at the design feature. If we work with the right people, they could remedy that pretty quickly. And then canceling the policy. And then that last piece was going to be the lapse options if, God forbid, we forget to pay a premium.
He's looking at me.
Right, we can also remedy that. But hey guys, right, hope you enjoyed this episode. And again, words are important, so forgive us if we always talk about the tax-free. Technically it's tax deferred, but now you guys know exactly what we're referring to.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.